Because if the market's down tomorrow or later this week or next month, and those gains go away, then the money's gone.
Make some decisions on how you're going to allocate your hard-earned retirement dollars.
Planning can be key and can be important as part of that.
Let's cut through the fluff. Stocks aren't just pieces of paper or digital tokens you trade like Pokemon cards. They're ownership slices of real companies. Think of it this way. If Tesla were a pizza, Elon Musk keeps the largest slice, but you could grab a crumb-sized piece for $200 and technically call yourself a co-owner. Hilarious, right? But here's the kicker. Those crumbs could either turn into a golden crust or moldy leftovers, depending on how the company, or the pizza, performs. Let's dig into why this matters for your wallet. Oh, and before we start, don't forget to like this video, hit subscribe, and ring that notification bell. Welcome to Market Reflect. You've probably heard that buying stock makes you a part owner of a company. Sure, technically, but let's get real. If you own 10 shares of Apple, Tim Cook isn't sweating over your opinions on iPhone designs. The real power kicks in at 5 to 10% ownership. At that point, you're the kid at the lunch table who decides what's cool. You can sway board elections, veto mergers, or demand they stop making those weird emojis. But here's the twist. Most retail investors own 110 shares. Your voting power? It's like bringing a water pistol to a nuclear war. Yet companies love this setup. They sell shares via IPOs, initial public offerings, to raise cash without owing banks a dime. Take Rivian's 2021 IPO. They raised $12 billion overnight, despite never turning a profit. Once those shares hit the market, though, they're trading hands like hot potatoes. You're not buying from Apple anymore. You're buying from Dave, a guy in Ohio who's panic selling because he read a meme about robots taking over. How to actually make money without getting scammed? There are two ways to profit: appreciation and dividends. Let's start with appreciation, the glitzy casino side of stocks. Imagine a struggling company like AMC. They're bleeding cash, but if Reddit's army of day traders decides it's the next big thing, the stock price rockets faster than Jeff Bezos's rocket. Why? Because stock prices aren't about reality. They're about vibes. If enough people think a company will dominate the future, its stock becomes the Tickle Me Elmo of Wall Street, absurdly overpriced, but everyone fights for it. Take Nvidia. Their stock surged 230% in 2023 because AI became the buzzword du jour. Never mind that most investors couldn't explain how a GPU works. They just piled in. Meanwhile, dividends are the quieter, steadier cousin. Companies like Coca-Cola or Procter & Gamble pay you cold hard cash just for holding their stock. Think of it as a thanks for not selling bribe. Not all companies do this. Meta and Amazon hoard cash like dragons, but the ones that do often attract retirees and risk-averse investors. The catch? Dividends aren't guaranteed. If a company flops, those payments vanish faster than your motivation to gym in January. Now, why do companies prefer stocks over loans, and why you should care? Here's a plot twist. When companies sell stock, they're not just avoiding debt. They're outsourcing risk. Loans mean monthly payments. Stocks mean you eat the loss if things go south. It's genius, really. They get your cash, and if the company tanks, tough luck, pal. But this also means stocks can be wilder than crypto. Take Tesla. Its stock price once swung 10% to 15% in a day because Musk tweeted a meme about funding secured. Meanwhile, companies like Webull and Robinhood make it eerily easy to gamble your life savings with a few thumb taps. Oh, and about those platforms. Ever heard of paper trading? It's like GTA for stocks. Practice crashing Lambos or portfolios without real consequences. Some brokers even toss you free shares, looking at you, Webull's 2 free stocks gimmick, to lure you in. But remember, if you're not paying for the product, you're the product. Robinhood made $1.36 billion in 2022 primarily from payment for order flow, PFOF. Spoiler alert, you're at the bottom. Not all stocks are created equal. Common stock lets you vote on corporate drama, but you're last in line during a bankruptcy fire sale. Preferred stock skips the voting rights but gets first dibs on dividends and assets. It's like choosing between backstage passes to a concert, common, or a guaranteed seat but no meet and greet, preferred. Take WeWork's collapse. Common stockholders lost 98% of their investment, while preferred shareholders, mostly venture capitalists, salvaged scraps. And then there's the dark horse, ETFs. These let you bet on entire sectors, tech, energy, AI-powered hamster wheels, without picking individual stocks. The SPDR S&P 500 ETF, SPY, owns fractions of all 500 companies in the index. Less risk, less reward. No, you won't retire early because of an ETF, but you also won't cry into your ramen if one company implodes. Why isn't your financial advisor telling you this? Let's get spicy. The stock market isn't a meritocracy. It's a popularity contest rigged by algorithms, hedge funds, and Elon's Twitter account. A company's stock can soar while it lays off 10% of its workforce or plummets after a record profit. Why? Because the market prices in expectations, not reality. Here's an exclusive nugget. Retail investors are the lab rats of Wall Street. High-frequency traders front-run your orders, institutions manipulate prices, and CEOs dump shares before bad news hits. In 2023, insider selling hit $50 billion in the US, coincidentally, before the Fed hiked rates again. But you can win. How? By embracing chaos. Buy stocks and companies you believe in, ignore the noise, and never invest rent money. Time is your frenemy. Day trading is a part-time job with worse pay. Long-term holds? Boring, but they compound like crazy. Warren Buffett's Berkshire Hathaway grew 3.8 million% since 1965 because he held stocks like Coca-Cola for decades. Diversify or die. Put all your cash in one stock and you're one scandal away from bankruptcy. Spread it out and you're armored against idiots. Looking at you, crypto bros. Emotions are kryptonite. Fear and greed turn smart people into bag holders. If your stock drops 50%, ask, is the company broken or is the market just moody? Stocks aren't immune to real-world chaos. During the Russia-Ukraine conflict, energy stocks like ExxonMobil spiked 80% in 2022, while European automakers, hello Volkswagen, tanked 30%. Even climate change plays a role. Insurance stocks like Allstate dipped 10% in 2023 after record wildfires. The takeaway? Your portfolio isn't just battling company drama. It's wrestling with wars, disasters, and TikTok trends. Here's the bottom line no one wants to hear. Stocks aren't magic. They're a roller coaster where the tracks are built by CEOs, torn up by hedge funds, and occasionally set on fire by geopolitics. But here's the truth. The market always climbs. Eventually. Since 1950, the S&P 500's average annual return is 10.5%, crashes included. The key? Stay on the ride. Still here? Good. Because the biggest secret is this. Stocks aren't about getting rich quick. They're about staying rich slowly. Now go forth, and may your dividends be juicy and your broker fees low. So, do you believe it's smarter to chase the latest stock trends or stick with the classic dividend payers? Share your thoughts in the comments. And that's it for today. Hit the like button and subscribe to Market Reflect. Stay tuned for more and catch you at the next one.